into the advisory and what is the best way to not only create wealth but also protect it. Tom Hartvigsen from Ord Minnett joining me now. Tom, great to see you. It's kind of like the old KISS acronym, right? Keep it simple, stupid.
That's correct, Juliet. Thanks for having us here today. So I think one of the things when we're talking about these types of strategies with our clients is determining what type of entity that they're looking to invest in. So keeping it simple, that's utilising the superannuation environment. It might be the utilisation of a family trust, a company, or potentially just investing in their personal name. So it's really about firstly pulling it back, looking at those entities and determining what entity is best suited for that particular individual.
So as you say, don't overcomplicate it, but a lot of it is about financial literacy as well. So tell us, some of the best ways that people can be using superannuation to their advantage.
Yeah, sure. So we're based in the Noosa area, and so for a lot of our clients, being retirees, super is literally the best retirement savings vehicle that we've got in this country. So understanding the basics of that environment is really, I guess, paramount. So as you listeners would know, in the accumulation phase, whilst you're working, contributions are going into this environment. It's really quite tax friendly. The earnings environment within super taxed at 15% in comparison to your marginal tax rate outside that environment. Then when you get to the point of meeting a retirement condition of release and potentially starting a pension, it then flicks over into that tax-free environment. One of the things that is, I guess, worth noting with the recent December inflation print that was put out yesterday, in fact, what we're going to see is a change in the transfer balance cap. Now, the transfer balance cap measures what amount an individual can have in that tax-free pension environment. So for an individual who hasn't yet started a pension account, from 1 July 2026, it's going to increase from $2 million to $2.1 million. So there's a bit of an uplift there of what an individual can put into that tax-free environment. And this is quite important as your listeners and viewers, I guess, start to plan for retirement or potentially starting a pension. There's a bit of a, let's call it, a benefit in potentially waiting until that 1 July 26 to get that bit of an uplift in what they can put into that tax-free pension environment.
Yeah, really important to sort of add, I guess, to take advantage of the tax benefits, but also the compound interest. Now, when it comes to asset allocation, we know diversify, but what's your outlook for 26?
Yeah, this is a good point. So we actually had a dial in this morning from another fund manager, and it just basically cements our view on the next calendar year. So where we're seeing diversification and asset allocation being key is obviously US markets and global markets have done well over the last, let's call it, 24 to 36 months. We will continue to see that push through over the next 12, but areas that we really like the look of are emerging markets, allocating to those global small and mid caps. So obviously the mega caps and the Magnificent Seven continue to do well, but we look in that sort of small to mid cap space, both in the US and then Europe and Asia. And one of the other asset classes that we really like the look of, particularly in this inflationary environment, is obviously gold and then real assets. So think of global listed infrastructure, toll roads, airports, utilities, etc. So we're liking the look of that. One of the other things that's worth looking at and keeping an eye on is the US dollar and hedging out potentially those strategies. So we're seeing the US dollar starting to creep up. We see that pushing through the 70-cent mark. So just, be aware, take note of potential hedging strategies too.
Yeah, the Aussie there pushing through. All right, let's get to estate planning advice as well, Tom, because often, these difficult conversations are what is needed to be had early, particularly when I guess it comes to who you're going to nominate to take over your bonds, your super, etc. What's your advice here?
Yeah, so obviously advisors work very closely with solicitors. So we always ensure that our clients are getting appropriate estate planning advice, and that is ensure the wills, power of attorneys, and those sorts of things are taken care of. But then on the super side, we obviously arrange and ensure that clients have appropriate super nominations in place. So in the event of their passing, their funds are passed on to the intended beneficiaries. So making sure on the accumulation side, you have what we call a non-lapsing binding nomination, and potentially then on the pension side, you make sure things like reversionary nominations are noted. One of the other things that's worth noting, in conjunction with that transfer balance cap uplift that I was talking about earlier, one of the other strategies that's worth looking at, just I guess to increase the potential wealth that's passed on through generations, is what we call a cash out recontribution strategy. It just minimises the potential death tax that intended beneficiaries may pay. So these are the sorts of strategies that's worth getting onto early while clients are still able to make contributions to super. It just helps clean up that taxable and tax-free component.